Hello, everybody. Welcome back, or welcome for the first time. If you haven't subscribed yet, please do. Brand new channel, good new content, and just another update on my trading. So, what you see in front of you here, so I'm not looking at you, all my stuff is on the left side here, is my portfolio. In my previous videos, I have gone through what this actually is and what it does. What I'm doing today is I'm quickly going to run through what the current situation is. What is the current situation? The current situation is that the markets have been very volatile lately, and there's been quite a bit of chop. I've had a significant drawdown throughout all of this. I've gone as far back as 16,678, currently sitting at 17,238, and that's down from January, let's just go back to January 12th when it all began, when I started taking track of all this, 18,056. Now, what has happened since then is that if you look at the market, January 12th, it would be right around here somewhere. Yeah, right there. As you can tell, there is no direction. It's all up and down. Overall, actually, it is down, but it's been choppy. It's been up and down all over the place. The VIX has spiked many times throughout that period. If we go back on the VIX, you'll notice that we spent quite a bit of time above 30, once, twice, significant changes, ups and downs, and volatility due to the political situation, due to the wars over in Europe, and due to the fact that the yield curve has inverted, which is probably the most important out of all of this. I'm just wondering why that's not loading right now. Okay, it is a big file. What you're looking at is my improved yield curve. I've actually redesigned it just a little bit so that I've kept the spread between the two to see when the differences are starting to get really crazy. That's when you know you have a problem coming. What is the issue? The yield curve has inverted last week, and that has a lot to do with the performance of the stock market right now. Like, we're expecting a significant drop, unfortunately. They're starting to pay more for the 2 years versus the 10-year. And that's all that it means, meaning that the bank is starting to lose money. So there's that. The USD Canadian sideways chop. Our gold position still on its way up. It looks like it's reached the bottom and it's going to go. Obviously, the market goes down, this thing goes up. We have our silver, upward trend overall, but slower. We have our copper, definitely in an upward trend. Everything is trending up, and oil hovering at around 97 as of Friday. Now, our dollar position versus Warby Parker is right here. There's all that chop I've been explaining. Yeah, it's quite a big one. I probably should have closed this, but I'm closed. I mean, I'm happy I didn't because I saw for what it is. I saw it for what it is, and I've kept some positions, I've closed others, and I've actually gone defensive. So currently, I have a very defensive portfolio. In some parts, maybe not, like this Cushman Wakefield here, but I decided to hold on to that one, and it's currently at a minus 16%. Like, I do still have a conviction that this company is going to go higher, but I may be closing it at 20, just to keep it down to this context that I'm not going to spend all my money on a single trade, or all the money that was invested into it, which is 900 bucks right here. I wouldn't spend all my money on it. That is all I could lose on that trade right there, so it's not a big deal. And then we have the junk bonds. It's all starting to perform a little bit better, but the CWK, as you can tell, is following the junk bond kind of. There's too much correlation here. I would ideally want this to be going in the opposite direction, and that's, it reflects in the ratio spread there that essentially is my profit. So currently sitting at a minus 110.89 cents on this trade. which is a long and a short at the same time. Now you have noticed that over the last month or so, the S&P 500 has been choppy. A lot of people have been losing their shirts over these things happening. That's because they're not hedged. You're always supposed to have a long and short position. If you only go one way, then you're fully exposed into one direction, which is not good. As the market retreats, you want to have something that makes money at that time as well, not just loses every time. And that's why majority of people will always lose money because they don't do this. They don't do hedging. Yes, I have one, two, three short positions, which I'm just exposed short because I'm a net short portfolio right now. I do believe the market's on its way down. I don't like what the bond market is doing, and the instability all over the world. Plus, the chain of supply has been completely disrupted over the last year, and this year the ships are standing in ports, and I don't see good things coming. Sorry. But yeah, I'm defensive at this point in time. There's my silver position. And IWM, that one seems to be recovering. It also had that chop. Um, tough times last month. Kind of shocked by all of it that was happening, but just stick to it. Don't over leverage, and I've survived. I was down about $1,000, and now I'm building it back up, which is great without adding any more money to the account. I've literally only lost 4.5% since January 12th. About the same as the S&P 500, but the S&P 500 is minus 15%, plus 12, back down to minus 10. It was so choppy, right? And that's what matters, is that you take out the choppiness. Yes, I've lost 4.5, but it's not the end of the world. I didn't lose 50 or 60, and that's mostly due to the fact that I'm long and short. Most of my portfolio, with a few which I'm convinced have a good conviction on, that it will go down because of my defensive outlook. So let's look from the back here. Here's my XLK and its performance. It seems like it's following the S&P, which I'm expecting to go down from here. So I believe the GDP will drop actually at the end of this month as well. From 7, we're going to go down to close to 0, my prediction anyway, but don't take my word for it. XRT retail sector. There's your platinum, long platinum, and short Microsoft. Yes, I'm shorting Microsoft because I think that tech is going to be one of the biggest losers in all of this market, bearish market, and what I mean. We're not there yet, but we're on our way. Viper Energy. It's an energy company, and it's one of them that's actually outperforming the rest of the stock market, the rest of the sector. Sorry, not the stock market. It's outperforming its sector. We should be getting out of energy, but obviously that's doing well. Right now is a good time to be in utilities, and I've closed a position in utilities at limit profit. They are due to go up. But what I also started doing is I stopped going long term with these. I'm just going to go short term with these trades, take a nice profit, close it at the next resistance or support if it's a short, and move on from there. Just have more trades, more setups, more opportunities. I've been holding on to too many trades, and it's just not a good thing when the market's so choppy. So I'm going to go shorter, and that works pretty well, actually. Platinum, Microsoft, we've been through that. Here's my gold, QQQ. That seems to be recovering at this point in time. And like I said, the market goes down, this thing will shoot for the sky, right? And currently I'm down 2.5%, which is equivalent of $5.54 in a minus in this trade. This was a lot worse. This was like minus 10% here. But it's recovering quickly, and just stick to the principles, and the principles are never invest more than 5% in any position on your portfolio. The combined two can make 10%. I'm actually doing less. These are still bigger than 10% because I've had a significant drawdown, but I'm building up to that. I would have reduced the risk number on this to 750, and as such, I would have been buying a lot less shares, or about one less, sorry. But yeah, that's the whole idea here is you want to keep your risk to a minimum. So never put more than 5% in any trade, and no matter how bad it gets, the risked amount on that bad trade, even if the company goes to zero, is still $900. It's not like half of your portfolio, right? So I'm not concerned with this 4.5. It is what it is. I've seen drawdowns way bigger than that before I started hedging, and in order to survive the chop, you have to be more or less neutral. But all of these positions, they have a bias. Like my bias is that the market's got nowhere good to go at this point in time. There's too much money in circulation, and the Fed is tightening into a slowing economy. Hello. So it's not good things are coming. Just an FYI, it's a good time to be in gold and utilities and defensives. Defensives. What are the others? We have your consumer staples, healthcare, telecommunication, like TELUS here in Canada, and utilities, like I mentioned. Those are the defensives here. Now I have a list up here which I use for reminding myself. In Europe, that's aerospace, food producers, beverages, pharma and biotech, telecommunications again, utilities like gas, water, and multi-utilities, because I guess they provide multi-utilities in Europe. Single companies do. Not like here. We kind of have our own thing and we do that. But that's where we're at. Unrealized back at minus 120, where over this time I was down a couple of times to like minus 709 here. Painful, but survivable, right? And like I said, the market's done some great big things here. I've gone defensive here, and then it rallied. And that's where that happened. But anyway, long story short, I am expecting this to go down. Okay, and that is the most important. And one of the biggest factors is this yield curve. We're outpacing the tens with the twos, and the curve is hit below zero, and I believe it's going to go lower to like minus zero point 0.6. Don't take my word for it, but I said it here on April 10th, 2022. Okay. Well, thank you for sticking around for as long as you have with this boring video. Sorry, I got nothing else to show you. I got a full-time job. I've gone back to work, and hence the timing of these videos is not going to be perfect anymore. But this is what it is. This is where I'm at. This is my portfolio. Share it, look at it, copy it if you will, but don't take my word for it. This is just what I'm doing. Just because I'm doing this doesn't mean that you're going to make money with it, because your timing will be different. Okay, you're going to enter the position at a different time, different price, and I'll close it at a profit, you'll close it at a loss, and you'll be pissed off. Never ever use leverage. Um, if you're new, especially. I mean, if you want to do options, just make sure you know what you're doing. Like I'm talking to the people who are just getting started. And that is the most important thing. Don't over leverage. And like I said, don't put too much in any position. Like current, do I have that here? No, it doesn't. Okay, here it is. Allocation exposure. So 5% per trade, I should be at about 10% for both of them. On this first trade, which is the dollar Werby, I'm 11.20. My second, the XLK, I'm only 2.67%. I could go more, but I won't. I'll just keep it there. It is small already, who cares? And it doesn't seem to be doing well anyway. And then there's my gold QQQ. I do want to put in more in gold, so that's one of my biggest options. I say risks here. But I want the extra exposure in gold because gold is due to go up, and here it is. It's 21.76. It's one of the only winners. This used to be all red last week, and it was painful to watch, but now it's recovering, and woohoo! Anyway, so you get another upgrade. There's the XLY. That's another one of my bigger positions, but this one's not doing so well actually, so just gotta hold on to it and all in all, it's a mathematical equation. Don't over leverage. Don't put too much in a single trade. Like for either one of these windows here, I should be as close to 10% as possible. Some of them will be bigger because of the fact that I want more of that allocation on purpose, though, not just because that's what it is. I want around 10%, so I'm not exposing my whole portfolio to a single trade. And even if both of these fail, that's a 10% I'm going to lose. And I mean fail, catastrophic failure where the company blows up and the stock goes to zero. That's what I mean, kind of failure. Um, what's going to happen is that when you're hedged, that hedge is going to do the same thing. And guess what? You're going to make so much money on that hedge that it's going to offset any profits that you've had and you lost or on the platinum, let's say, whatever. I mean, that's a commodities. That's a bad example, but Ben on Tesla. I'm actually short Tesla here. Who would short Tesla? Well, me. Whatever. I'm shorting Tesla. I'm expecting it to go down to 800s. And that's that. Like you be long Tesla. I don't care. They got great news coming up. That's awesome. I've only bought or sold one. So worst case scenario, this goes up to $10,000, and then I lose a lot of money on Tesla. But chances of that going to $10,000 are astronomical. Like it's not gonna happen overnight. First of all, have lots of time to get out. And even if it does, okay, in that section, I would lose that much money. But Tesla would have to go from $1,000, 1,025.49 on Friday, to $10,000 overnight for me not to catch that. You know, so the hedge covers your risk when the market falls on the long side, and that is why I'm only minus 4.5 right now. And like I've only like throughout January, I've only added about minus 3% overall to this. I was down 1% while S&P was down 15%, and then it had that little rally. It actually went positive again for a little bit, and now it seems to be going down again, and everybody's in a panic. Don't panic. Just look into the future. A month ago, this was, the yield curve was telling us this is coming. People are not paying attention, but 10 minus 2s are right here. And when that gets to zero, things get really interesting. So we were there for a moment and we bounced. They've added some more points to the interest rates there, the overnighter. And yeah, they're tightening into a slowing economy. Enough said. That is where we're going to end this video. Sorry for me blabbing. If you did get to this, you're going to love the content that's going to be coming up. I promise. This is the way to do it. This does make money. And, sure, it hasn't shown you that over the last month, but it's been choppy. Everybody goes through this. The main part is that your risk management does not allow you to lose more than 10% or something. You don't want to do that. And it gotten pretty close to that when I reversed into defensive and then we had the rally. Whatever. Just don't overdo it. Don't over leverage. Don't put all your, eggs in one basket, and you live to survive another day. That's the proof of that right here. Are we ending this video? For any one of you that really want to see what I've done there over the last January 12th, here's the whole history. And anytime I've added some info, slow this down if you want, but you can read this, and that's exactly what I'm saying here. Freedom Convoy, I remember that. That was awesome. Aggressive tightening expected. They're doing that now. That was in February. Rampant inflation, Fed minutes flat to negative, major tech sell-off. That's, when we had a big sell-off. Macro is very negative, confirming reception. Russia enters Ukraine. Second quarter will be ugly. I'm actually still saying that. That's, it's probably getting worse. Building a new portfolio built up on mostly ETFs, and that was February 24th. I should have done that earlier, but I wasn't paying attention. I was sleeping. I was injured. I wasn't spending too much time in front of the computer. I couldn't sit in front of the computer for a while. Uranium position. I've opened that up, and yeah, uranium didn't do so well, so I closed that really quickly. Added some EDV and XLU. I've actually taken profit on XLU twice now. The utilities, they've been doing pretty well. And, once again, that's going back to long and short, and I'm only taking small profits at a time now. I'm just staying within the range because of the chop, It's not really investing time right now. Now, Fed raised the rates once again because they're going into growth, or slowing growth, and should be lowering the rates right now, but it's the opposite. Took small profit on the club HYG, and this is where I started taking these smaller profits, and things get a little bit more interesting because the portfolio starts rebuilding itself as you actually take profit. You can have so many different positions, and unless they go way out of range, you're never going to make money on them unless you close it, because eventually within the range they'll turn back and you lose all the profit that you've built up. And that is why I started just cutting them. It's a nice profit. Keep the losses at least the 1/3 of the wins, and just take the profit. Just take it. You know, everybody wants to go for the hundreds, but if we take it $20, $40, $70 at a time, I think it's reasonable to expect a good outcome. So if you look at my profit, the lowest it's been to minus 1400. So now we're going to go to minus 682, building it back up. Anyway, have a nice day, and we'll see you on the next one.